capital goods and infrastructure. Let's quickly go across to Darshan first to find out what the wish list looks like. Darshan.
See, as far as capital good goes, Devina, the first thing that the industry wants is that some kind of import duty on Chinese power equipment. You know, BHEL and L&T for long have been lobbying for this. So this will make, if this happens, this will make it as a level playing field for all the capital goods company. What they also want is that the credit availability should actually improve for the capital good industry, and there should be more focus on creating more power plants as well as renewable energy. So if that happens, a lot of these capital companies, and in terms of renewable energy, a lot of companies like Suzlon and Lanco, which now have entered, Lanco has entered in the solar power, they will benefit. As far as infrastructure goes, the wish list is pretty much common. They want more emphasis on roads and highways. So a lot of these companies are getting into these BOT projects. So they want more emphasis on this. The JNNRUM project should actually extend. They should have more facilities. So companies into urban development like Simplex Infra and all will benefit. Credit availability should increase. They should get more credit, because most of the companies work on a very, very high debt levels on project level, and they don't want an increase in MAT rate. You know, currently it's 18%. There are expectations that the MAT tax level can go up to almost 20%. So if that happens, that will be negative. So infrastructure companies are saying that this increase should not happen.
All right, Darshan, thanks very much for joining us and giving us a quick snapshot of the budget wish list from the capital goods as well as the infrastructure space. Gaurang, just to touch base upon the point, you know, the major expectation, particularly from the capital goods spaces, you know, probably the level playing field for most of domestic players in the form of import duty, which is closer to 15 to 20%. On the other hand, this is not expected owing to the strong lobbying that's going to be taking place, and if it does actually take place as the import duty is actually put on, then this will be a positive for most of the big players here. But do you expect such a thing to happen? And then again, would you take a play on any of these capital goods stories?
I think, you know, L&Ts and the BHELs of the world are definitely must in one's portfolio, and of course, if this kind of initiative is taken round about this budget on different kind of duties which is there. And not to forget, you know, you have a great competition from China, and we had concerns expressed by one of the leading capital goods engineering company in India, expressing those kind of concerns as far as the equipment goes which comes in from China. So I guess it is going to be prudent. Now, if you want to give growth to the domestic players, and if you want them to, you know, compete with international players, you have to make a field which is of an absolute level. You cannot have imbalances over there and expect performance to come through from these kind of large companies. So I expect that this time around, not only on capital goods stroke engineering, but also on the infrastructure, Devina, if you're talking about 8.59% GDP growth, they're in a saturated environment where you have right now in infrastructure. I think it's going to be very, very difficult. Execution is the other problem with these kind of, you know, mega infrastructure projects, which are crucial for the national's economic growth. There has to be something done in terms of single window clearance, etc. And of course, you know, a project of importance which contribute to the growth of the economy, I think you should give them some kind of tax benefit also going forward, which will attract. And the bond market, you know, last time around we had some mere 20,000 rupees which you can invest and get tax benefit. I think that should be, you know, widened to a larger extent, so that more individuals in higher tax bracket can participate in this kind of bond market as far as infrastructure. And largely, I think, you know, your bond market is dominated by government securities. There are very few private players which are existing in that kind of a debt market. So you should have a, you know, broader market and a larger ticket size to make infrastructure projects viable.